Hey, what's up, guys? We are at an early morning Holy Macro show this week, so I have to head out. I have a funeral up north in Cleveland today, so I'm gonna be heading out pretty soon. Wanted to just hop in and like update you guys on a few things that have been going on, things that I've been looking at, things that Kashop's been thinking about, and how the markets are going to react to these things. So, there's been a lot of headlines. I don't know everything that's been going on this week, and I'll be completely honest, I really have no idea. But the one thing I can think about is we did have the Fed. Basically, Warsh had a meeting, and he basically talked about the fact that the inflation numbers are down. Obviously, the monetary policy is working. I thought that was insane. Um, made me laugh a little bit because I was just like, man, I just this guy is phenomenal because he got on and he just pounded his chest about how you know hawkish he was and how he's going to raise rates and how he sounded like damn Volcker. He sounded like Volcker. He's like he's going to come out with that's a guy, for you guys who don't know out there, that's a guy, the Fed chair from the 70s, had the big cigar, would come out and talk about raising interest rates as high as possible and having to kill inflation. And and he just kind of came in and kept raising rates and raising rates. It sounded very similar to that. He was like, we will be data dependent and we will continue to raise rates when we see inflation and blah blah blah. And everybody, got spooked. Everybody went long dollars, long bonds, thinking monetary tightening was coming. In my opinion, it was just he couldn't have come out there any other way, man. Like he couldn't have come out there any other way and said, "Hey, I'm going to be cutting rates. Hey, I don't think rates should be as high as they are." If he said any of those things, we'd all know he's just a puppet for Trump. So he came out, he said the opposite.
And we still know that, right? I mean, I don't think that's in doubt.
I
I
don't
mean, we still know that.
I know
Yeah.
that. You know that. I don't think the general public knows that. I think the general public thought the opposite when he came out and said the opposite. And but if you watched his interview the other day, it was the opposite. He was very dovish. So I think it's going to be a lot of hawkish talk, a lot of dovish moves, and that's really what we're going to probably continue to see. So I think at the end of the day, it's like this guy is just going to give a good boost to long-term interest rates, probably hold down the short end for a while. But if he's holding down the short end, that's going to create more inflation, which is the reason why I say if you're holding down the short end, especially artificially, you're not doing it like if you're doing it in a way that the 2-year yield is following. The 2-year yield is falling pretty hard, and then you have this, once again, the Fed tries to catch up with monetary policy, and they start to lower rates with the 2-year yield. Most of the time, that's going to work out pretty well. That's going to be the right market environment for them to do that right type of policy. Currently, we see the opposite scenario. Long-term yields and yields that aren't tied to the Fed rate are rising as the Fed is holding rates low. That usually creates a lot of inflation. That's what we call a bull steepener. And so this is a bull steepener. And so this coming out of, this major inversion, one of the biggest inversions we've seen, and everybody was like, "Oh, it's the biggest inversion ever." And I keep mentioning to people, this is the biggest inversion since the 70s. Looks very similar to the 70s. And coming out of that inversion is when we started to see gold bottom and everything. And also we saw the commodities complex bottom at the same time. Gold usually leads that charge. Saw gold make its big moves in end of 23, 24, 25. And then basically now we started to see energy catch up. And currently this still looks pretty set up for energy to go a lot higher. So Kashop, interest rates are probably one of the most important things we look at as macro traders. And that's really what I want to start doing here every week is kind of understand what we're doing at a macro complex, and maybe we'll move to micro after that. But Kashop and I are always starting with the macro complex. So as a macro trader, you're always looking at interest rates, trying to see what's going on, trying to see where to position yourself. What are you seeing currently right now from the Fed, interest rates, monetary policy? Anything people need to be looking out for?
So, Wash has been kind of stealing the show, but there was this other governor who came out and said that shrinking the Fed's balance sheet is the wrong idea. That those were the exact words he used. And that's kind of the core premise of their reserve management program, where they're saying that we can't call it money printing, the helicopter Ben era, where they just said, if there is deflation, we'll just get onto a helicopter and drop bags of money all over Manhattan. That era's over. So the one that came after that, they called it quantitative easing. which is sort of similar to money printing, but not quite. It's like, you say shell shock and then you say PTSD. It's kind of like that. And now they're like, oh no, we cannot use the word PTSD anymore because, everyone knows what it is. So let's find a new term. And they are like, let's call it RAMP, RMP. And that's what they are doing now. And they're saying that we should not shrink the balance sheet. And lo and behold, like Tavi Costa had this chart where he showed that US M2 has increased at the fastest pace in something like 5 years. And it's like just going bonkers. And you would not know this from whatever the rhetoric is or what the Fed is saying. Hey, we are serious about controlling inflation. We are serious about 2%. Yeah. You can talk all of that. But then look at the data. What does the data say? Highest increase in M2. And that's really the data point. Look at what the banks are doing. If you look at, so that's the nice thing about the Fed, this is something that's sort of underappreciated by the market. You go to the Fred database, which is the St. Louis Fred database. You can actually get all of this data straight from the Fed itself. So you go there and you type WALCL. You can look at what is their total assets. You go there and you type M2 and you can see what's happening to M2. So whatever data point that you need, they provide it right there. And if you go look at what's happening to the total deposits in the banking system, going straight up. Look at what's happening to total liabilities, that is the total loans provided by all the commercial banks, going straight up. Every data point that you look at, it's all going straight up. And that's money printing showing up. And if you needed other evidence of money printing showing up, just look at what happened to the major indices from the start of the Iran war to now. Oil went down, unexpected. Stocks went up, again unexpected. So all of this is just money printing showing up in different ways. And then you look at, of course, you look at gasoline prices. That's your everyday indication. You go to the supermarket. That's your everyday indication. And then you look at consumer expectations. I think the survey goes back to something like 1957 or something, and consumer expectations are at its lowest point since the survey was being conducted. So this is a survey which has survived the LBJ Great Society, it has survived the stagflation, it has survived the tech boom, it has survived the housing crisis, and consumer sentiment is at its worst even compared to all these events. So now that tells you something. So overall, all the evidence that we are seeing, if you ignore what Wash is saying, if you ignore the rhetoric, you look at the evidence, everything says inflation, inflation, inflation. And that perfectly segues to this chart that you just brought up, and I'll let you talk about it.
Yeah, so we got a lot of inflation, Kashop. That's the truth, and I think a lot of people will look at it and go, I mean, that's the thing. Everybody is so. How do we speak about human beings the right way? Well, everybody's so short term. I mean, it's a problem with traders. It's a problem with people who want to start a business. Whatever it is, like people are too short term with their thinking all the time. They overestimate what they can get done in a month. They underestimate what they can get done in a year, and they continue to do that over and over again. So you have to. All these people want immediate results. So, like in their opinion, hey, inflation's a little bit better. Hey, we did have $5 gasoline in Ohio, a couple months back. Now we're at $4. That sounds pretty good. People forget that that's still a huge increase from where we were at the beginning of this year. At the beginning of this year, we were under $3. We were around $2.60 a gallon. $5 is nearly 100% increase. A little bit below that, where we're at currently, we're still talking about an over 50-60% increase. This is still a problem. Like, this is not something that has been solved, and people keep acting like this is solved and everything's great and everything will be fine. And it's like, just look at the numbers. I mean, heating oil up 230% year to date. Now, a lot of people, when I say heating oil, they're like, well, it's not winter. Heating oil is the equivalent to, it's very close to jet fuel. It's very close to diesel fuel. So when you look at heating oil, think of diesel prices, think of shipping, think of the ability to ship things in trucks, the ability to ship things in planes. All of this goes into the heating oil price. Now we have gasoline up 106% year to date. Now we have crude oil, 84% for Brent, 69% for WTI. So I don't understand where people keep getting this hey, we don't really have that much inflation thing going on. I mean, some people send me that trueflation shit or CPI stuff, and I just want to punch them in the face. I'm like, have you just look at the commodity prices? Like, I understand, like, what they read. Like, this is how you get ahead of the Fed. You don't read what they read. Yes, I understand that they'll see the CPI reports, the PCEs, and all of these different economic indicators, which are very lagging. If you go forward and you look at the actual prices like we're doing today, you'll see that it's telling you everything you need to know. Grains are up. You got wheat up 30% for the year. You've got rough rice up nearly 30% for the year. You got soybean oil up 55% year to date. Natural gas is even up 27% year to date. Cotton, soybeans, go down the list. A lot of these commodities are up. The things that you're seeing at the bottom, if you're looking at silver, already made a huge run, obviously gave some back, makes a lot of sense. Platinum, same thing. Palladium, same thing. So the precious metals have just kind of given up the ghost. Bitcoin, of course, at some points that's going to have some big pullbacks as well. And then orange juice at the bottom of the list. Orange juice has no correlation to inflation for the most part. I don't even know many people who drink orange juice anymore, knowing how sugary it is and how bad it is for people. Orange juice concentrate isn't a thing as much as it used to be. I could see orange juice continuing to fall off of a cliff unless you have some sort of supply disruption. The demand for it is way down currently. So looking at the rest of it, it's like all you're seeing is inflation out there. So I just want to, take a little trip through this. If we're also looking at the energy sector year-to-date performance, I thought this was interesting, Kashaf, and you've been mentioning, technology at some point will pull back and might be pretty nasty. And we're also seeing energy year-to-date, with the pullback, energy is not sitting at new all-time highs. Energy is a little bit below their all-time highs currently, but still up nearly 30% year-to-date. Technology behind it up 15% year-to-date. So, Kashaf, what are you thinking here about energy technology? Do you think technology is really kind of dead in the water here? Do you think that, you've been talking about the possibility of a bear market in technology for a while, which would cause a bear market in the United States? So what are you thinking here, right now? And, we're in summer 2026. What are you thinking traders should be thinking about the technology sector?
So I do own technology stocks, but the difference is that I own the software space, and the software space. The last time software had a great bull run was from the COVID bottom all the way until 2021, and it's very similar to the kind of momentum that you're seeing with the semiconductor names today. So if you go back to that cycle, what happened was software companies were starting to get priced at 100 times sales. And the reason for that was, hey, look, everyone's sitting at home, people are just ordering stuff online, and these companies are growing, and you're going to get rid of conferences. You don't need these Las Vegas convention centers anymore, you just need Zoom. So this was the thinking. Software had a great run, and then of course the world either mean reverted, or you can say the COVID madness ended, and then people started going out again. The bubble burst, then you had the 2022 bear market, and after that it was all AI. And the AI thing, what it did was it made people think, hey, I can use AI to create any software that I want. I can use AI to write code. So why do I need all these software companies? Let's sell them all. And that's pretty much what's been happening for the last 3 years. So if you look at IGV versus XLK, and you have to be careful in that you have to remove Microsoft from IGV. So if you do that, you will see that software as a ratio compared to the XLK, the broader technology sector, is just gone down, down, down. And what's happened is that some of these companies, the valuations have fallen. Their revenue growth, which was already there, has sort of kept accelerating. They have got their share-based, some of them have got their share-based compensation under control. And now these are starting to, they're not value stocks in the traditional sense, but they are decent bets on growth and at a reasonable price. So they are the GARP stocks. So I have a few of these in the portfolio, but the broader technology space, I think it's untouchable because the valuations are too rich, the forward projections are too crazy, and it kind of gets me when you see all these journalists write saying that the Mac 7 is now the cheapest it has ever been. And I'm like, what are you talking about? They have added something like $10 trillion in market cap, and you're saying they're the cheapest they have ever been. And they're like, well, it's cheaper because, look at these forward earnings projections, those forward earnings projections have come down so much. And I'm like, yeah, that's exactly what a cycle is. If you have a cyclical stock, we take the gold miners. So Franco Nevada at 100 PE, is it expensive? It's one of the best gold royalty companies in the world. At 100 PE, is it expensive? No. All that 100 PE tells you is that their earnings weren't so good in the past because the gold price was low or the commodity was headed lower. And now at say 20 PE last year, everyone's like, this is the best stock in the world, and look at how much it's growing. Look at how cheap its PE is. Look at how cheap its forward earnings are. And then you're like, yeah, then gold went from $5,400 to $3,900. And suddenly that same stock, which looked cheap back then, looks expensive now. So this is how it is with cyclical sectors. You cannot just go by the forward PE ratio. In fact, it's a ridiculous metric to look at for a cyclical stock. And that's kind of what journalists focus on. That's not what I do. That's not the work that we do. So I would say this is the year in which the semiconductors, the hyperscalers, as they are called, the Mac 7, all these parts of the complex, they are going to take a hit and software is going to start to shine. So there's a nuance there, but that's how I view technology.
Speaking about technology, my computer updated last night and it literally just finished the update in the middle of the stream. Don't know if I cut out completely there or not, but man, technology is interesting in many ways. But I do think we could see a scenario here where, and I don't know why this is like that. We'll just have to take that top for what it is. But yeah, I don't know why exactly technology does that from time to time, or the updates do that from time to time, but here we are. But yeah, so, getting through that, I'm wondering more too is what do you think about technology being in that cycle? So many people always ask this question to me whenever I talk to people, which is what do you think technology is going to do? And if technology, gives up the ghost, basically has a big pullback, let's say semiconductors stop moving up, let's say they fall, 20, 30%. What do we think about the US stock market then? Do we think there's a possibility of the US stock market even holding up? Or is that a scenario where everything changes pretty quickly?
So I think the Trump account was as big a topping signal as any. So the cult of equities. So this started with the death of equities in Business Week. 1979, pension funds were given a mandate saying, we cannot make money in stocks, we cannot make money in bonds. Let us invest in diamonds. And the who was the regulatory body controlling these pension funds said, yes, it makes sense. You should invest in diamonds. And then Business Week comes out and says, this is the death of equities. This was 1979. And then Walker comes in, and then the US dollar recovers, the economy rebounds, and the market has its best run ever. And then, you have books like Stocks for the Long Run that are written, which says, hey, just put all your money in a Vanguard fund and retire, and you'll be fine. And then that thinking catches on, and then you get more and more of these ETFs. And finally, this month, the culmination of it is the president saying, every child in America needs a Trump account with $1,000 in it or whatever. And that's like, wow, this is in just 25, 26 years, the cult of equity has come full circle from saying no one should invest in equities because, it doesn't work, to every child should have an account because that's the way to build wealth. So I don't think we get a bigger topping signal than this. So I think this is it. And what I would like to clarify, because everyone thinks, oh, he's a perma bear. No, what will actually happen is that over the next 10 years, you will have a lot of volatility up and down. But at the end of it, you will have close to zero returns. And even if you do have returns because, Wash comes in and starts printing money again, you have, let's say, 2% real return, whereas gold is giving you a 10% nominal return and probably a much higher real return than that. So, something of that sort is going to happen. And at that point, you will look back and say, man, why did I stick with equities? And it's the same sort of crisis that the Bitcoin people are facing now. Bitcoin was like, oh, look at how well it's done in the past. And you saw all these charts which say, look at Bitcoin versus gold versus the S&P 500. The Bitcoin is the best, gold is okay, stocks are okay, but Bitcoin is the best. And then 5 years later, it's at the same level. It did have its up and downs. If you traded it, you made money, but as a long-term investment, it's been dead. And that's exactly what's going to happen to the S&P 500, and I think that's exactly what's going to happen to the Nasdaq. I think the Dow will survive. I mean, it's survived for more than 100 years in its current form, so the Dow probably does okay, but I don't think the S&P 500 and the Nasdaq 100 are going to do as well. But here's the interesting part. I think if you build a strategy which shorts the SPY, which is the market cap weighted S&P 500 index, and goes long the RSP, which is the equal weighted index, I think that delta is going to perform amazingly because small caps are going to rebound. And that's exactly what we saw after the dot-com bubble burst as well, where the big moves were in the small caps. And I think that's coming. And I think the sector rotation that I think you're going to be talking about, that's coming. All these factors are very, very bullish. It is just bearish for the guys who think buy this Vanguard ETF, the S&P 500 ETF and retire and you're good. No, that strategy is not going to work. That's going to have a bear market. Active investors, we are going to do so well in this new era.
No, I agree. I think that's where you have to be because there's so many things to do and so many things to position, and that sector rotation is going to be important. And it's not only active, it's going to be the people who are macro traders, people who have no problem going to different sectors. I think too many people, and I think this is a big problem with traders generally, and why most people lose money in markets is everybody gets very stuck in whatever theme they're in. It's if I'm in a theme of gold miners, I only really like gold miners. If I'm in a theme of semiconductors, I'm only going to really buy semiconductors and really believe in them and be long, or technology generally. Or then getting into, I'm a commodities guy, I only, buy commodities, whatever it is, like you just don't want to be stuck in any theme. A lot of people think because I'm trade commodities, I'm always like, I'm bullish commodities at all times. It's like, no, basically since 2020, I've been very bullish commodities. But if you look at the portfolio, my own portfolio, I'm long and short things all the time because there's always an environment to be long or short something. So once again, you just want to be diversified across all these different sectors. And I think, one way to look at that very easily is just looking at the not spider sectors anymore. What is it? State Street or Select Street? I can't remember. State Street, I think, bought them not too long ago. And now basically all the ETFs have changed a little bit. The construction's about the same though. And so if you look at all the ETFs here, we're kind of looking at the bottom of the list. Then these are ranked by 52-week highs. Technology has had the biggest pullback, as well as energy, even though energy is the one kind of making a comeback currently right now. We're looking at financials at the top of the list. We're looking at real estate at the top of the list, and healthcare. Very odd movement that I don't see usually. And the thing I'm going to say right now is going to be unpopular, which is I would assume these two, meaning real estate and healthcare, fall on the list pretty quickly. I bet utilities also falls on the list. I would assume things like materials, industrials, technology, energy, and possibly financials stay up at the top of this list for a little while. Sorry, not technology, but energy. I would assume these stay at the top of the list. And the reason why is I think we're still in a reflationary style environment heading towards stagflation, if anything. And that's the thing, like we're only between two regimes. We talk about this all the time, and I'm always talking about the regime we're in as traders. And the regime we're in sometimes is between two regimes. And we've honestly been shopping between reflation and stagflation for over a year now. And my models never say that for that long, but it literally has been hanging out right in the middle. So one thing we're seeing in that type of environment, we're seeing that energy continues to lead the way. And as that has happened, that is leading me more to think stagflation is coming, meaning and that's not to say like everybody goes stagflation, you're talking about hyperinflation or anything. No, I'm just talking about low growth, high inflation, or no growth, high inflation, or slowing growth, high inflation. So I think that scenario is coming here. And the reason why is if you look at XLE over year to date, it's leading the way. Last 6 months leading the way, last 12 months leading the way. If this thing starts to get back up to those old highs, and starts to really lead this pack, like I think we're heading towards a pretty nasty environment at some point. Be great for us as traders that can be in just about anything. It'll be fine. Most people, though, they won't be, and it'll look more like 2022, where there's only a couple sectors that are moving, and basically technology, all the big communications, discretionary starts to slow down. I'm still currently, Kashop mentioned he's long some software stocks. I'm currently even long semiconductors, but we'll see when that ends. So at the moment, it's just, some of these things are moving. Even technology hasn't broken trend yet, but it is coming. It is rolling over pretty quickly right here, right now. Let's see if we start to get a breakdown right in that zone and start to head lower. But for now, let's just watch and wait. And as you're seeing, there's still a lot of reflationary sectors up near the top of the leaderboard. We're seeing banks are up there, oil and integrated, oil and gas, banks. I don't think we have a crack in here, meaning the refiners ETF. So that's not in here. So, but that would be up here as well. Integrated freight and logistics, marine shipping, REITs, hotel and motel. So, like, once again, we're kind of seeing that reflationary environment continues to hang on here. Trucking, that should also be labeled under reflationary. Trucking's near the top of the list. So we are seeing a lot of things that are continuing to say we're heading towards a reflationary environment. So, Kashop, this is one I wanted to get through today with you and like everybody on here, because there's some interesting stuff happening in the currency markets. So we're kind of seeing the euro is trying to give this false breakdown signal. We're seeing the Great British Pound had a big week. It's been moving up really nicely, pretty quickly. So that's a huge move that's been happening pretty soon. These are all consolidating though, so I'm not getting too bullish or bearish on any of these. I'm just saying these are back into the range. Let's see if it can break to the upside. And then the yen, something that you and I need to talk about a little bit more, because people keep asking the question, what's going on with the yen? What's going on with Japan? So what are you thinking about this, Kashop? What's going on with the yen? You tell me.
So the current regime is what they are saying is that, I mean, so the yen, it's a problem. So when the yen broke the 160 level and it hit 162, a lot of Japanese importers went bankrupt. It was front page news. And what the government is doing, what they are saying right now is they want to get Japanese institutions to take their savings, take it out of the US and other markets, and put it more into the Japanese markets. And whether or not they succeed in that, I don't know, but they are actively trying to do something. And the yen at 162 at a 40-year low, it's a national embarrassment. So there are two things that they can do. One, they can say, let's sell our treasuries, let's support the yen, let's unwind the carry trade, let's get interest rates up, and whatever this does to bank balance sheets, we will just handle it. And they can actually do this because all the Japanese government debt that is held internally within Japan, unlike the US, where 30-40% of your debt is held by foreigners. So Japan can actually say, and they are a very close knit society, so they can say, let's take the pain, let's strengthen the yen, let's end this national embarrassment. Or they can say, you know what, it's happened, it's hit a 40-year low. Let's try to sort of manage it around this level. Let it try to hit 170. We will sort of find a level of support there, and let's just end the carry trade from now on. And help the banks repair their balance sheet, help them get rid of their US treasuries. So Norin Chunkin, which is one of the big agriculture banks, what happened was they had a lot of US treasury exposure, and then when the Fed raised rates, they had huge losses on their bond portfolio. And what they did was they sold those bonds, they took their losses. I think the CEO stepped down, got fired, the way it works in Japanese society. So now the new leadership, what they have done is they have taken all the cash and they have put it in Japanese government bonds. And now Japanese government bond yields have soared, and once again they are losing money. So what did they do? Well, there are no easy answers. So this is a political problem as much as a financial problem. So it is really impossible to tell how this gets resolved. Maybe like a new Plaza Accord like they had in the 80s. I do not know, but this is one of those critical things to watch, because whatever Japan does, the earlier there used to be a quote saying when Japan sneezes, the US catches a cold. And that's coming. I don't know in what way it's coming, but that's definitely on the cards, and that's on the cards quite imminently. So if you are trading macro, this is one of the most important things to watch. What is Japan saying? What is the JGP yield saying? What is the Bank of Japan doing? And what is the currency doing? So you need to watch all of this data if you are invested in, especially if you are invested in US tech. If you're invested in other things, if you're invested in gold, it doesn't really matter. But if you're invested in US tech stocks or US treasuries, then this is absolutely the thing to be watching right now. And all I can say is just watch it. Don't have predisposed notions, because no one knows what's going to happen. This is unprecedented. But when it happens, that's when you will have to put on the trade, and you just have to be mentally ready for it at that point.
No, good point. Because there's always a trigger. And so looking at the dollar, the dollar has basically come out of its range. And really my line in the sand was around 101, looking for a weekly close, really getting above this major resistance zone. A lot of people draw resistance the wrong way as traders, and that's the thing that a lot of technicians do and that they teach is it's got to all be just based on, whatever the lowest point is or what's the first point of resistance and so on. If you talk to old school traders, the way they did it, they once again they didn't have computers, so they would draw charts and they would take a pencil and they would put a pencil over this area and go, okay, this is where the most lines are hitting. So basically, like, you want to know where that zone is. And once again, they always say with resistance and support, you don't want to draw it with a pencil, you want to draw it with a marker, meaning you want these wide. So looking at this as kind of a wide zone, that's why I picked 101 to 102, basically being around that zone. Now we're kind of coming back. Really, I think the dollar's going to get back into this range, and I think that'll be positive for a little bit. But I think that big move that Kashap's talking about, that we're all talking about, when it really happens, I think the dollar is going to be crashing. Now, everybody thinks that the dollar crashing is going to mean, stocks up, and certain stocks will go up, especially commodities and cyclical based stocks. But if we're kind of in this zone and we break down, I don't think that, technology is doing very well in that environment. I don't think, semiconductors are doing well in that environment. And I do think by the year end, we're probably going to see the dollar getting down to that 95, 92 level pretty quickly and decisively. And so, a sector that I wanted to ask Kashap about before we got to hop. And sorry, guys, I do have an event that I got to get to Cleveland for today. Just want to hop on with you guys for a minute. Kashap, looking at oil and gas, production, looking at the large cap names, the whole sector, refiners, whatever you want to go, wherever you want to go with it, we're seeing a lot of strength coming in. But the thing I want to see, and I'm wondering about with your opinion, is do you think it's time to start looking at the explorers yet? Because we talked going back to last year, we started to get very bullish on the exploration stocks. I know that's your wheelhouse, something you cover more than anybody else. And so the exploration stocks and the gold miners made a lot of money in those. Those did really well. Do you think we'll see a similar scenario in energy just yet? I'm very torn on this. I still think it's kind of large cap refiners type time currently. But I'm wondering, with your expertise, what do you think about this? Do you think it's time to start moving into these different areas? Or are you seeing a lot of value in these areas right now?
So if you look at why the gold explorers in particular, they re-rated a lot, it was because gold moved from something like $1,800 to 3,800, $4,000 nonstop. It was a straight up run with very predictable and shallow pullbacks. So that's the kind of environment. And in the same period, the financing environment got much easier because liquidity flowed. So that was the perfect storm which helped the gold explorers re-rate. Now with oil, the problem is you do not have that environment. Yes, oil prices have gone up, but everyone thinks oil prices are only gone up because of the war. That's a perception problem. Now, if the war ends and oil prices continue to go up, then that's the environment in which these explorers, the oil exploration stocks, will re-rate. I don't think we have that yet, but I think we probably could get there. It's a good time to build a watch list. It's not a good time to go all on the oil exploration stocks, thinking that the same experience we had with gold is going to repeat.
No, sounds good. And let's end it there. All right, guys. Thanks for joining us. We'll be back with you guys next week. Normal time next week, 10 a.m. Eastern time. So if you guys have any questions, feel free to drop them in the comments. Please like this, share this, subscribe to the channel. We love to do this. I put out a lot of information, interviews with traders, and I'll be doing a little bit more work on the channel lately. So would love to have some support from you guys. And I'll see you guys soon. Thanks for joining me as always, Kashop, and I'll see you next week.
Of course, Jason. Have an okay trip, and sorry about your uncle.
Will do. Thank you.
Yeah.
If I could hit the button, that'd be